All right, let's jump right in. We're going to explore a connection in corporate finance that honestly sounds a little crazy at first. We're talking about the link between how much debt a company takes on and how much people trust each other in the town where that company is based.
It's a weird question, isn't it? I mean, really, what on earth could the fact that you trust your neighbors have to do with a company's balance sheet? Well, as it turns out, there's a deep, powerful force at play here, and we're going to figure out exactly what it is.
Okay, so to get to the bottom of this, we first have to understand a fundamental conflict that exists inside pretty much every big company.
It's called the agency problem. And yeah, it sounds like something straight out of a business textbook. But the idea is actually super simple. The people who own a company, the shareholders, are not the same people running it day to day. Those are the managers. And, their goals aren't always perfectly lined up.
And you can see how their goals can really split apart. Shareholders, they want one thing: make the company as valuable as possible. But managers, they're people. They might be thinking more about their own job security, or maybe building their own little kingdom inside the company, or even just avoiding a risky project that could be amazing for shareholders but might get them fired if it goes south. That's the dilemma.
So the big question is, how do you get managers to toe the line? How do you get them to focus on what the owners want? Well, for a long, long time, the classic answer has been debt. Think of it like a financial leash.
Now, the fancy term for this is corporate leverage, but all it means is how much debt a company is using to pay for its stuff. That's it. So when investors want to get management to focus, they often make the company take on more leverage. So how does this leash actually work? How does it keep managers in check? Well, it works in a few key ways. First off, when you have huge loan payments due every month, there's just less cash sitting around for managers to spend on wasteful pet projects. Second, banks don't just give you money and walk away. They watch you like a hawk. And third, there's the very real fear of missing a payment. That threat of financial disaster is a heck of a motivator to stay on your game.
Okay, so we've got the problem, the agency problem, and we've got the traditional solution, debt. But now we're going to throw a curveball into the mix. Let's talk about something that seems totally unrelated, social capital.
At its core, social capital is basically the glue that holds a community together. It's that feeling of mutual trust, the general willingness to cooperate, the sense that people are looking out for more than just themselves.
So think about a town where social capital is high. People there are just, they're more trustworthy. They cooperate. For a manager who lives and works there, their personal reputation in that community is a big deal. The local vibe, the norms of being honest and fair, it actually seeps into how they behave at the office.
Okay, and this is where it all comes together. This is where the two sides of our story, corporate debt and community trust, finally meet. What if that trust, that social glue, could do the exact same job as that financial leash of debt?
This is the big idea from the research we're looking at. It's a hypothesis that says, hey, if managers in these high-trust towns are already motivated to do the right thing because of social pressure and their own reputation, maybe you just don't need to put them on such a tight financial leash. Maybe trust can literally replace the need for debt.
And guess what? That is exactly what the data shows. The central finding is just crystal clear. The more social capital you find in a company's home county, the less debt that company uses. Period. And this isn't just a one-off. You look at thousands of companies over decades, and the pattern is incredibly consistent. Firms headquartered in places where trust is low carry way more debt than companies in places where trust is high.
And we're not just talking about some vague feeling here. This is a real, measurable economic effect. Just a standard bump up in a county's social capital score is tied to a 0.60% drop in a company's leverage. Now, that might sound small, but for a company worth billions, that's a huge deal. It represents a massive difference in financial strategy.
Okay, but you might be thinking, is this for real? Couldn't this just be some random coincidence? It's a fair question, and the researchers knew they had to prove that trust was really causing this.
So they did this really clever test. They looked at companies where it's super hard for investors to see what's going on inside, what they call high information asymmetry. And what they found was that in those exact situations, when investors can't easily check up on managers, the effect of social capital was the strongest. In other words, when you have to rely on trust, the trust level of the community matters the most.
All right, so this is super interesting, right? But it's way more than just a neat fact for a finance textbook. This has some serious real-world impacts on how businesses operate and grow. And get this, it's not just about how much debt they have, it's about the kind of debt. Companies in high-trust areas use less bank debt, which comes with all that intense monitoring we talked about, and they use more public debt, like bonds, which is much more hands-off. It's like the lenders themselves are saying, yeah, we trust you guys more, we don't need to look over your shoulder so much.
So what does this all add up to for a company lucky enough to be in one of these high-trust places? Well, it's a massive advantage. They've got way more flexibility in how they finance things, they have a lower risk of going bankrupt, and it's easier for them to get the money for those big, ambitious projects that create real, long-term growth. So, the single most important thing to take away from all of this is that a community's social fabric, its trust, its norms, it's not some soft, fuzzy concept. It is a hard, tangible financial asset. It literally affects the bottom line.
And that leaves us with one last big question to think about. If we know that community trust is a valuable economic resource, what's the real, hidden financial cost that we all end up paying when that trust starts to break down?